Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have George Day, Chief Investment Officer and Portfolio Manager at Weatherbie Capital, a wholly owned subsidiary of Alger. We're going to discuss portfolio positioning heading into 2023. George, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill, and great to be here.
Yes, thank you. And markets in 2022 certainly challenging considering the volatility that we've seen over the year. We have inflation concerns, we have macro concerns. How has this impacted the way that you're managing portfolios?
You're absolutely right that the macro situation has been pretty tough. You've got the inflation, you've got rising interest rate, you've got the geopolitical instability between Russia and Ukraine. Also have the residual impact of the COVID. That has caused the market to correct rather significantly this year. Now, Weatherbie Capital is a wholly owned subsidiary of Fred Alger and Company, and our specialized growth strategy has dual mandate, that is growth and quality. And in early part of the 2021, we actually realized that the inflation may not be as transitory as the Wall Street believed then. As a result, we pivoted and made some adjustments to our investment strategy. Now, specifically, we put incremental emphasis on quality. And quality means sustainable competitive advantage. It means strong pricing power. It means the management's proven ability to execute. And high quality is often manifested in free cash flow generation as well as profitability. So these have been the adjustments that we have made.
So liquidity is drying up a bit. Inflation is starting to come down. How are you going to find opportunities for your portfolios? Where do you see these opportunities?
Yeah, Winston Churchill once said that never let a good crisis go to waste. And at Weatherbie Capital, we actually are taking advantage of the market correction to benefit our clients. And specifically, we have been doing two things. One is to upgrade the quality of our already high quality portfolio by putting incremental capital to the high conviction names. And the other thing we have been doing is to establish new positions in high quality, high growth companies that used to be high flyers, but the market has brought them down to earth. And so we've been doing these two things.
So as an active growth equity manager, you focus on fundamentals. Before you said free cash flow as an example is one of the fundamentals that you focus on. Can you share some examples of your current holdings?
Absolutely. So at Weatherbie Capital, we're not only investing, for example, technology and healthcare, as a lot of our peers do, but we also find a lot of gems in mundane industries. For example, waste management. Now, Casella Waste is one of our top holdings, and Casella is a waste management company, and it is vertically integrated, and it has a leading market share in the markets that it serves. This company has demonstrated its ability to pass the rising cost to its customers, and is very savvy in deploying technology to improve its operational efficiency. For example, technology like the routing software, like the scheduling software. As a result, this company has been able to consistently deliver solid results and generate free cash flow. So this is a company we continue to have strong conviction.
And with volatility in the market, certainly there are opportunities to short some stocks as well. Can you give us some examples or themes that you're looking at there?
Absolutely. The SPAC shorts has been a theme that we have explored in the last 2 years. And so what is a SPAC? SPAC stands for Special Purpose Acquisition Companies. Now the private companies combine with SPACs to go public. Now, if we turn the clock back to the early part of 2021, when the market was in exuberance and the valuation was sky high, and the SPACs at one time became the actually even a main vehicle, a bigger vehicle for private companies to go public than the traditional IPO route. So we actually took note and studied the SPACs for several months. And we concluded that the SPACs are generally of lower quality, and these are for the companies that are not good enough to take the traditional IPO route to go public. Now, these companies often lack profitability. Some of them lack revenue, and a portion of them don't even have proven products or services. And in addition, their internal control, their transparency, their compliance often are inadequate. So after these private companies combine with the SPACs and go public, their performance in the public market has been dismal. And realizing that, we actually launched a well-designed campaign against many of these SPACs.
So what's your view on the markets going into 2023? Is this going to impact your portfolio construction at all?
Yes, so 2023 is going to be, it's going to remain pretty tough because we continue to have the rising interest rate, the geopolitical instability will still remain, and we may enter a recession soon, or maybe we are already in a recession. So what our strategy is to continue our strategy which we have deployed in the last 2 years. That is to emphasize on quality, and specifically upgrading the already high quality portfolio, and also establish new positions of the previous high flyers, which now the market offers us at a very attractive valuation. So many of our strategies are available on the Nasdaq fund network. Now, the small cap growth area is the segment of the market that is perhaps most inefficient in the public marketplace. And now the valuation has come down significantly thanks to the market. The combination of these two actually offer patient and experienced investors great opportunity to discover and generate value.
Experience being the key. Back to your earlier point, George, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.